at historical risk and historical returns, and then the way we made risk evaluations. We then take the perspective of the future where we were dealing with expectations in order to calculate expected returns and volatilities or risk measures for individual assets. And then we moved beyond individual assets and had a very first glance at portfolios. And the takeaway here should be that, well, whilst the return of a portfolio is the average of the share of each of those assets in a portfolio, this is not true for the variance. I mean, when assets are somehow correlated, work and move in either similar or different directions, if depending on how economy evolves, then this relation or this correlation, the way these stocks behave amongst each other in comparison. So if you compare the development of one stock with another one, then the effect that they somehow are related to each other, which is then measured by this correlation coefficient, results in, well, the risk to decrease if like such portfolios are considered. And we'll talk about this in more detail in the next part of this lecture, while starting to look at the trade-off between risk and return, right? So far the first part of the lecture was about measuring risk and return. So someone asks you, well, how can we measure risk and return? You should be, once you understood this chapter and you recapped it, to calculate and do this kind of analysis, right? And now we are going to talk about this trade-off. I mean, recall we also talked about preferences, that people would prefer safer under versus non-safe and the like, so risk and return are related to each other. And we'll talk about this trade-off right now. So in order to get the intuition of this risk-return trade-off, let's consider the following example, right? So suppose you have one asset, or you have basically here those 4 assets which might differ with respect to the return, the risk, and the risk-return ratio, which we're going to see in a second what this is. So suppose you have one asset with an expected return of 10%. and a risk of losing everything of 50%. So you have a return of 10% and a 50% chance to lose everything. The risk and return ratio you could calculate, well, by simply taking the risk of losing divided by the return, which would give you a risk-return ratio of 5. Let's see in a second where this leads us. Suppose now we have an asset B, which has an expected return of 10% and the risk of losing also of 10%. So same expected return as asset A. However, a much lower risk of losing everything. If we now put this into risk-return ratio, we would say 10% divided by 10% would give us a risk-return ratio of 1. Okay. So already when we compare asset A and B, we would say, well, both of them offer us the same expected return. However, the one is much more likely to lose everything versus the other one. So intuitively, we should take the one with a lower risk-return ratio, right? So I mean, this has the same return, however, with a much lower risk to lose everything. So when A and B are compared, I mean, you should definitely take the one with a lower risk-return ratio. Now, there is another investment, expected return of 40% versus risk of losing everything 50%, right? So much higher expected return, same chance of losing everything as so far option A, which was so far the worst. Risk return ratio 50 divided by 40, 1.25. And now suppose we have option B, 40% expected return. So the same one as option C, which is the highest so far in terms of return. And only 10% of losing everything, which is as low as option B, which was had so far the lowest risk, and so far also the lowest risk and risk to return ratio. So option D has the highest return, expected return, with the same chance of losing everything as B, which translates into a risk return ratio of only 0.25. So the lowest risk to return ratio, so you get most out of it with the lowest risk. This is basically what we intuitively talked to in the beginning, right? I mean, if you get more with less risk, so between C and D, you should choose, well, the one which gives you the same expected return with the lower risk. So when you compare C and D, you should go for D because it offers you 40% with a lower risk. And now the same holds true when you compare A to B. That's what we talked about, right? You would here have 10%, both the one with lower risk. So you would go for option B because it has a lower risk, 10% versus 50%. So the best amongst those offering 10% expected return is B. The best in terms when offering 40% return is option D. But now when you compare B with D in terms of their risk, they have the same expected risk of losing everything, whilst option D offers us a much higher return. So when same risk, higher return is considered, we should go for option D, right? This is like the intuition, right? This risk-return trade-off that, okay, when we have different risks with same returns, go for the one with the lower risk. When you have differences in returns with same risks, go for the one with a higher return. Okay, now we've already learned how to measure risk in terms of volatility, right? That was the first part. Well, but in general, what do we mean by risk? And we will also talk about it later in more depth. But I mean, risk can be chance and opportunity. It's both, but it's the negative side is, well, yeah, there is a chance of losing money. You also have the opportunity to gain it, right? But there is this chance of losing money. And in general, well, the higher this chance is, I mean, or the more risky it is in terms of losing money, well, the higher you risk it and the more compensation you would like to have. In general, one could say that, well, we would like to avoid to some extent excessive amount of risks, right? On average, well, investors might be perceived to be to different extents risk averse, right? Some of the risk we might perceive as good. So it's also a trade-off. That's what I meant, because the more risk we take, the more return we can expect. Yeah, however, too much risk, well, might have catastrophic implications. Yeah, you might get completely broke. Lives might be destroyed and the like. So one needs to find the right balance between risk and return. This leads to, well, some questions which we are tackling or partly already tackled. How can we avoid risk when investing? We'll come to this diversification in more detail. Should we fear and hence be compensated for bearing risks? And should we be compensated for all sorts of risk? We'll come to distinguished forms of risks in the later part of our today's lectures. Are there different types of risks? Well, and from this question, it should be clear, well, there will be, and we will discuss which ones. Well, and basically complementing the second part, should we be compensated in the same way for all parts of risks? Well, partial answers, as already indicated. we can avoid risks by not focusing on the risk of a single asset investments, but by portfolio investments. That's what what we did here when we calculated the risk of the portfolio, taking into account that we had this correlation between the stocks. What we did in a mathematical way for this one example, and you can check it yourself. If you take the weighted average of the individual standard deviations, you will get to a higher number than the risk of the portfolio, and we will see it later in more detail, but we already covered this in first parts. Right? And in the end, we will be able, and we will see this later, that we can distinguish between different types of risks. There are independent risks, which are kind of stock specific, idiosyncratic individual risks, versus common risks which have to be faced by everyone. And we will see and discuss this in subsequent slides. So independent versus common risks, in order to understand this a little deeper. Let's face the following examples. So you have $1,000 for investment capital, right? $1,000. Regardless of the investment size, the chance of winning is 60%. And if you win, you win. You double your money, while the chance of losing is 40%, and then you lose everything. Meaning, for each dollar you invest, well, you can either double it, meaning for each dollar you invest, you can double this $1, meaning it becomes $2. This is the case in 60% of the chance, in 60% of the cases. Or for each dollar you invest, you lose everything, which is in 40% of the case. You have now two investment options. Option A, you will have 1,000 individual investments of $1 each, in which the outcome of each investment is independent of the others. Yeah? So think of it as 1,000 individual lotteries, so to speak. You have $1,000 available. With each dollar, you buy one ticket, and each ticket has a chance to either win and double with 60%, meaning you would have $2, or in 40%, with 40% chance, this ticket will give you 0, meaning you would lose your one invested dollar. This is option A. So basically 1,000 lotteries you play, each lottery having a 60% chance to double, meaning to make $2 out of it, or to lose everything, meaning you would get $0. Option B, you might still have 1,000 individual investments. However, you can see them as you buy 1,000 lotteries, which are, however, played simultaneously in one round. So you would say, okay, we play this game. We have the 1,000 lottery cases, but you know, the 60% apply, or the 40% apply to all of them. Meaning, it's not that I play this lottery for each of the one lotteries individually, but I play it for all the 1,000 simultaneously, right? So I basically invest. Maybe it's easier to think about them. I have 1,000 individual investments, which are put into one bulk lottery ticket. And this one bulk lottery ticket I play, and then it's win or lose for all of those $1,000 tickets that are contained in this bundle, right? Well, as you can see already in the slide, where the first case where you play basically 1,000 individual lotteries, well, you would say each investment has independent risks because each lottery is played individually. Whilst here in this bundle scenario, where you might have individual investments, but they are basically put into this bulk together and they played simultaneously, well, they share a common list because all of the 1,000 investments in this bulk well, are prone to the same risk because they are played in the same moment. And then whatever happens, whatever the outcome is, all of the 1,000 individual investments would be affected in the same way. Well, and now the question is, which option is more risky? What would you think? What is your opinion? Is option A more risky or is option B more risky? Okay, I see in the chat already one response. Think about it. What do you think is more risky, option A or option B? Well, I already seen the correct answer. Let's make this a little clearer. So what you see here in the beginning is the summary of what you saw here, just put together in a more compressed way. Well, let's start with the expected return. Well, the expected return for both options would be the same. You would get in 60% 2,000 and in 40% 0, right? So because in option A with the 1,000 individual stocks, you would for each of those 1,000 tickets play 0.6 times 2 plus 0.4 times 0. And this is as 1,000th of the whole investment. So you would do it for all of them. So your expected return in both cases would be 60% times 2,000 plus 40% times 0. So the expected value for both stocks is 1,200. However, here in option A, the average realized return, well, it would be equal to the expected return, right? I mean, each of those individual investments has an individual risk of 40% failing. But in the end, you can expect that on average, you will realize 1,200. And then with this volatility measures, well, some of the lotteries might lose, some of the lotteries might win. It is quite unlikely that I generate 0, right? Because in 60% of the cases, I should win. So I would expect that 60% of my individual lotteries would actually win. That would give me the expected 1,200 euros. So really realizing 0 is quite unlikely. However, in option B, well, it's really do or die, or not all or nothing. It's not Russian roulette. It's not perfect Russian roulette. But I mean, with a 60% chance, all of the investments will win, meaning you would make a return of 2,000. And in 40%, with 40% chance, well, all of the $1,000 investments would generate 0. And then you would have 0. So in practice, here in option B, there are only 2 possible outcomes. You can only have 0 or 2,000 as an outcome. Recall, you have 1,000 individual investment put into a bulk. Then the bulk is basically put into this lottery, and 60% the bulk gets into this 60% case where all win. But in 40%, if you take the bulk and throw it into the, or it's destiny decides that, okay, we are in the 40% scenario, the bad state, then all of the investments contained in this bulk will generate 0. So in option B, all of these individual investments are prone to the same risk, meaning either all of them make $2 or all of them make $0. So you would have either with 60% chance 2,000 and with 40% 0. And in option B, each of those investments is treated individually. So for each of those investments, $1 investments you would play individually. So you play the first time, in 60% you will get 2. In 40%, or with 60% chance, you will generate $2. With 40%, $0. Then you play the second $1 investment, okay? With 60%, you get 2, with 40%, you get 0, right? So in this case, you will not only have the case that either I will have 0 or 2000, but you will get, within this distribution of values, you will get something between, which on average is 1,200, but might be, either 1,000, 1,300, 1,400, but you have a diverse range of values which could take place. While it's an option B, it's basically all or nothing. You either get 2,000 or you get 0. So the takeaway should be, from what I said, option A is more predictable or less risky, right? Because you have many individual rounds of games where every time you have the 60% chance to win or lose. However, option B, well, it's one, you play it once, the game, for all the 1,000 investments. So you either have 0 or 2,000. I mean, in the good state, yeah, in 60%, you might have a high reward. But also in 40%, well, you get a really bad outcome of 0, right? And recall the way we defined also risk in context of volatilities was, as you might recall here, we have an expected value, which in our case would be 1,200. And then if we have only here the two extremes of 0 or 2,000, well, that would be if we applied our variance formula, right? Deviation from the expected value, very risky as compared to the case in which we play individually and have here this distribution of values, right? So this should be a takeaway for you here. At if we play all these games individually, right? We have lots of independent risk, whilst if we have big common risk, all investments in one bulk, played at one time, it's all or nothing. We can play this rationale even further, right? So suppose this was our original option A. 1,000 individual investments of each $1 each. Each investment is independent of the others. The expected return is 1,200 as we've derived. And the realized returns, will lie within this, depending on how we define the, which interval we take. But let's suppose we take here the 1 or 2 standard deviation prediction interval, right? So the realized return should lie in a range as specified by our standard deviation, and without going into the maths here too much, can be derived that, well, if we had the respective information, we could say if we have these 1,000 individual investments with a 40 to 60 win or lose relation, we can say that we would expect our realized returns to lie within this range as specified by our standard deviation. So between 1,000 and 1,400, right? So we would expect it to lie somewhere within this range. That was our option A regarding the 1,000 individual investments of $1 each. Now suppose we would move here to the left, which would bring us more and more to option B. So the very modified option A is actually what we had here summarized as option B. But let's go step by step. So let's now suppose that we would not have 1,000 individual investments of $1 each, but let's suppose that we would have 10 individual investments of $100 each. So we wouldn't play 1,000 individual lotteries, so to speak, but we would put into each, we would basically generate 10 bulks, and in each of those bulks, we would put 100 of those, 100 investments, each with a value of $1 into it. And then we would play, or then we would consider this investment option. So not 1,000 individual investments, but 10 individual investments with each size of $100. So in total, we would still have the $1,000 investment, but not, again, as an option A, 1,000 individual investments of $1 each, but 10 individual investments of $100 each. So we would have basically not 1,000 times the lottery plate, but 10 times the lottery plate, so to speak. And each time the lottery played, $100 would be at stake. The expected return would still be 1,100. For each of those bulks, we would have 60% times doubling. So 60% times doubling $100 would be 60% times $200 plus 40% times $0. And that we would do for all the 10 individual investments. So our expected return would still be 1,200. However, yeah, something we are not deriving here now mathematically, but what can be shown based on the standard deviation, yeah, we would then see, well, our realized return would not lie any longer between 1,000 and 1,400, which was the range we specified if we had 1,000 individual investments of $1 each, but we would see that our expected return would now lie between 700 and 1,800. And when we compare these ranges of expected or of returns, of realized returns, well, we see we move from 1,000 to 1,400 from this narrow range. So the lower bound was here 1,000 with, let's say, 95% confidence, to 700. So we have a lower bound. So the range increases from 1,000 to 700. Well, but also the upside is higher, right? So we move from 1,400 to 1,800. So we have danger, higher danger in our investment, meaning we, to a certain confidence level, would not any longer be bound to 1,000, but we could go down to 700. But on the other hand, maybe we will not only end up with 1,400, but to a certain confidence level, well, we might end up with 1,800. So risk is higher, danger of losing more is higher, but also we have more opportunities, right? You see, so this risk has two components. So we have higher opportunities for an investment with the same expected value and basically same probability distributions, but also the opportunities are higher. Well, and if we move from modified option A to the very modified option A, we are at, well, option B, right? Option B was we have one investment. So we do not have any longer 10 individual investments of $1 each, but we have one investment of $1,000. So to make the storyline clear, we started from option A where we had 1,000 individual investments, each of $1, which has expected return 1,200, and the realized return lie in a very narrow range between 1,000 and 1,400. We moved from this 1,000 individual investments to 10 individual investments of $100 each. It gave us the same expected return, but more risk in terms of the realized returns because the range became bigger. And now we move to our initial option B, one investment of $1,000. Expected return is still 1,200, but as described beforehand, well, here it's all or nothing, right? We have everything in one bulk. All investments are in one bulk. The game is played once. With 60% of the case, we double, so we get 2,000. That's the upside, you know, that's our opportunity. But the danger of this whole thing is, well, in 40% of the cases, the whole bulk gets zero because they are all contained in the same bulk for which this game is played. So here our range is the largest, so highest risk. We could also move option A to the right, meaning to move beyond 1,000 individual investments of $1 each, we could even make it smaller, right? I mean, here we decreased the individual investment size. So we moved from 1,000 individual investments of $1 to 10 individual investments of $100 to one investment of $1,000. Now we could also move in the other direction. So we move from 1,000 individual investments of $1 to, well, 10,000 individual investments of $0.1. So in total, we would still invest our $1,000. Well, what would now be our implication? Well, we would still get the same expected return because for each of those 10,000 investments, we would play in 60% of the cases, we double. So 0.6 times in 60% we double. So from $0.1 to $0.2. And in 40% of the cases, we get zero. So in 40% of the cases, we get zero. And we play this 10,000 times. So 1/10,000 times 0.2. And this we make the 10,000 times. So in the expected return, we would expect $1,200. Well, and what about the realized returns? Now we can see that our range of realized returns would narrow further, so we wouldn't be any longer between 1,000 and 1,400, but between only $1,100 and $1,300. That would be our range of which, to a certain confidence level, we could expect the values to be, right? Importantly, it's not excluded theoretically that you would win all of the 10,000 bets, which is why, you know, this is like a confidence level. Theoretically, it would be possible that you win all of these 10,000, right? And you would get then a realized return of 2,000, but it's very unlikely, right? So here, these levels, these ranges give you like the confidence level either to 65% confidence level or to 95% confidence level, right? But here you can be assured that they have the same confidence level. And as you see, the more I split the investments into lower tranches, smaller tranches, the more the realized returns narrow down and the more they get close to our expected return. So expected returns per se, well, they give us what we can in general expect out of an investment, but then the form of how this investment is conducted, meaning is it conducted in one in total, or is it like subdivided into different tranches of different sizes? This highly impacts then the associated risk, right? So return is the one thing, because from the return perspective, all of these investment opportunities look identical, right? All have the expected return of 1,200. However, the way these investments are conducted or sliced impacts the risk. And if they are sliced more and the slices become lower and lower and lower, meaning the more often you play the same lottery for lower parts of the investment, yeah, the closer you will get, the closer your realized return will indeed be close to your expected return. But in the case of option B, you know, you would play basically all or nothing, which is quite risky. Now that it's 10:59, I would like to give us our half an hour break. And after this break, after this break, we will continue with this analysis and then also go beyond or focus further on different forms of risk, and then particularly talk about correlations, you know, this correlation coefficient, which I mentioned beforehand when we considered stock A and B and the portfolio correlation. But now it's 11 o'clock. Let's take a chance to take a half an hour break. See you at 11:30 German time. So 5 hours later, Vietnamese time. So 4:30 Vietnamese time, I guess. And have a good break. Relax a little bit, and then afterwards we go to the second part of today's lectures starting from 4:30 Vietnamese time. Have a good break.